My quick takes on the budget. As a caveat, I haven't got through the full documents as yet, but there are a few initial observations that I can make right away. First, on the budget math, we were personally expecting the finance minister to stick to a 3% fiscal budget deficit target. Clearly, the market was expecting a much higher fiscal target, closer to 3.4% or so. In that sense, 3.2%, the target for FY18, is somewhere between market expectations and what we were expecting. While we are slightly disappointed by the 3.2% for FY18, what I do notice is that the quality of income which has been, or expenditure which has been proposed by the finance minister is actually quite good. There's a substantial increase in expenditure on the capital front. There's a lot of money going into rural, into agri, into infrastructure. There's also been the inclusion of low-cost housing into infrastructure, which is very positive for the economy as a whole. So overall, the quality of the expenditure has to be lauded, and that's good news. So even though there is a slight slippage of 0.2% from the original FRBM target of 3%, it's going in the right direction. So to that extent, that's the overall on the fiscal deficit. As far as the borrowing program is concerned, we're still trying to reconcile the numbers. The gross borrowing plan of 6.05 trillion rupees seems very much in line with our expectations. We're still trying to reconcile the math on what's come out so far in the press on the net borrowing program and on the redemptions. But at least the gross borrowing program seems to be pretty much in line with our expectations. On other positives as far as reforms are concerned, concerning the whole market, I think transparency has to be a key word of this budget. The move towards political parties now having to maintain records of any donations over 2,000 rupees, I think that's a huge positive, and a step clearly in the right direction to make the whole economy a lot more transparent. The finance minister also alluded to using the data coming out of the demonetization exercise and the cash deposits thereafter to actually try and increase the tax net, which is again very, very positive for the economy as a whole. So transparency through these means is a clear welcome. The other reform which we liked is in respect of FIPB, the fact that we don't need the FIPB anymore for FDI investments. That clearly will speeden up the process of investments. So a whole bunch of reforms which should augur well for the economy as a whole. There's also relief in terms of what didn't happen, which the market was fearing. So there was, for instance, the fear that the finance minister may introduce long-term capital gains or increase long-term capital gains tax on FI investments or in equity investments. That's clearly not come through, which is a sigh of relief. He's also extended the concessional withholding tax on specified foreign currency borrowings and INR borrowings, particularly for the FPI and ECBs. That 5% concessional withholding tax is now extended to June 2020 from June 2017, which is again a positive. Thirdly, there's relief in the sense that the service tax has not been increased in the run-up to GST. So that was again a fear in the market that there might be a tick up in service tax, as anyway when the GST is implemented, the overall tax rates could go up. So all these are I think positive relief for the market. Between reforms and these kind of relief for the market, this should augur well for stock markets and for all asset classes in India. We should see flows coming into the equity markets. As far as bond markets are concerned and currency markets are concerned, I think now the attention will shift to other factors. There's a lot of headlines coming in from globally, particularly from President Trump and the US. They will continue to dominate movements across the globe. By itself, I think there's still a good case for the Reserve Bank of India to do a cut of 25 basis points in the next policy meeting. While there are lots of ponderables and imponderables, including what's happening globally in terms of the risk of trade coming down, global trade reducing, the risk of populism, etc. I think as far as CPI inflation is concerned, the RBI will have a lot of justification to introduce one more rate cut. We expect the January CPI to be in the region of 3.25%, given the softness in the trajectory of vegetable and pulse prices, which continues into January as well. And this is a lot lower than the 5% that the RBI was penciling in for the first quarter of this year. So given that alone, I think the RBI will have a lot of room for rate cuts. Of course, they might ponder over on the slippage of fiscal deficit to 3.2%. While it's a lot better than what the market was expecting, I think the RBI will clearly want to make sure that there is a that this doesn't outweigh the benefits of lower inflation. Overall, we still think there's a strong case for a rate cut coming in the next policy by 25 basis points or so. Having said that, while that might be a positive for bonds in the short run, there still are a lot of imponderables in the global markets. I personally think that while short-end yields can come down in the run-up to the RBI policy and beyond, longer-end 10-year bond yields will continue to remain where they are, or maybe a small rally of 5-10 basis points, but it should sustain beyond that. We still think the 10-year bond yields will be in the range of 6.35% to maybe 6.65% over the next few weeks. That's broadly a call. Still a lot more to be read in the details of the budget document, but very broadly, the emphasis on infrastructure spending, on capital spending, on rural and agriculture and irrigation spending is very, very positive. The inclusion of low-cost housing into infrastructure is a huge positive. There is a lot of reforms on the anvil, particularly in the sense of transparency, and of course making FDI easier with no FIPB required anymore. There's relief in terms of no additional capital gains tax on equity investments, and the extension of the 5% concessional withholding tax till 2020. And all in all, I think it's a pretty positive budget. We should still be in line for a rate cut coming up the next week, given the trajectory of CPI. Having said that, watch out for global events. There's a lot happening in global fixed income and currency and commodity markets. India can't be immune to all of that, and we will tango with what's happening in the rest of the world.